Hello and welcome to the Credit Compass, your guide to navigating European credit markets. Each week we unpack key developments in credit, explore the macroeconomic forces shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. This week, I would like to quickly highlight the impact of heat waves on the economy. Further to that, I will provide some insights from our recently published Forward Look. This is the second iteration of our quarterly publication where we look forward and attempt to show you what we see happening in the world and what it means to credit markets for the quarters ahead. I publish a report covering Europe and the UK, while my colleague Van Hesser publishes perspective on the US markets. They can both be found on our website, KBRA.com. All right, let's get into it. The ongoing heat wave sweeping across Europe is beginning to weigh on economic productivity, particularly in labor-intensive sectors like agriculture, construction, and manufacturing. Extreme temperatures are reducing working hours, straining energy grids, and curbing outdoor economic activity, with southern and central Europe hit hardest. According to Allianz research, for Italy, the impact of the current heat wave could shave as much as 1% off of GDP. With nuclear power plants being shut down and even tourist sites being closed. The Eiffel Tower, for example, was briefly shut in Paris due to the heat, and a general slowdown in activity, cafes shut, labor work tempered, etc. According to the European Environmental Agency, productivity losses during heat waves can reach up to 10% in exposed industries, with further ripple effects through supply chains. While warmth can attract tourists from cooler climes, can also keep many closer to home without the need to chase the sun and sand abroad. Higher cooling demand also pressures the energy grid and as a result energy costs. Further, drought conditions threaten crop yields, raising food prices. Overall, the heat wave is a growing drag on short-term output and a reminder of the economic risks posed by climate volatility. All right, with that said, let's get into our look into the quarter ahead. Europe, a region that's been long overshadowed by American exceptionalism and geopolitical tension, but which may now be showing the first signs of meaningful momentum. We're going to unpack why Europe might be on the verge of a slow but important pivot from stagnation to recovery, and what that means for credit markets, policy, and investment opportunities. So let's start with the basics: growth. In the report, we outline that for European economies, it is improving modestly. We're not talking about a roaring comeback. This is more of a gradual uptick. Tailwinds are gathering, especially from a wave of government-driven investment. Defense and infrastructure spending plans are starting to trickle through the system, especially in Germany, which has traditionally kept a tight fiscal stance. And this matters. Germany isn't just any European economy, it's the engine. It's the largest trade partner for 17 out of the 27 EU member states. It is a top 3 trade partner in all but one. And when Germany flexes its economic muscle, the effects ripple across the continent. While European recession probabilities remain elevated, they've been steadily declining. Take Germany. At the beginning of the year, recession odds were north of 50%. Today they've dropped to around 40%. France tells an even more dramatic story. Recession probability halved from 60% in May to 30% in June. So what's driving this shift? Well, in our view, it's largely stimulus. Not just any stimulus, targeted investment in areas like defense, infrastructure, and energy. These aren't short-term consumption boosts, they're long-term capacity builders. So what does all this mean for credit? Well, we're seeing a broadly supportive market environment for European credits, both public and private. Investor appetite is growing, driven in part by the search for dollar diversification. With U.S. policy creating global uncertainty, European assets are benefiting from their relative stability. In the report, we highlight both a number of tailwinds and headwinds for credit investors. In terms of tailwinds in Europe, we have healthy consumers and banks. European households and banks remain relatively healthy, offering a cushion for credit markets. Government spending, as I mentioned, pro-growth fiscal policy, particularly in Germany and France, is helping to lift the broader region. And the German pivot, measures like tax cuts, energy support for heavy industry, and increased infrastructure outlays could help to reverse Germany's recent struggles. But we can't exactly get too comfortable. There are some serious headwinds on the horizon still. Tariff chaos, for example, the trade tensions, especially with the US, which have mounted even over this past week, are clouding the outlook. The lack of a finalized EU-US trade agreement keeps uncertainty high and investment cautious. Second, as we have highlighted on a number of occasions, bond vigilantes. They are back. Governments have been spending heavily, and that pushed debt levels higher. As a result, borrowing costs are rising, which could weigh on future fiscal flexibility. Third, margin pressure. For corporates, it's a triple whammy. High financing costs, elevated input prices, and potential new tariffs. While defaults aren't surging, we don't expect significant improvement either. Regionally, there are clear differences. Germany, as we've discussed, has been under pressure from energy shocks to falling Chinese demand. Policy is responding, and that gives hope for a turnaround. France is also improving with declines in bankruptcy rates and ongoing stimulus plans, albeit with a challenging budgetary situation and, according to some, elevated levels of corporate distress. On the flip side, the UK continues to underperform. May's growth data showed contraction, and policy momentum has been tepid. It's an outlier in an otherwise stabilizing European landscape. So, what should we take away from all of this? Well, Europe isn't in full recovery, but the pivot is real. It's slow, it's uneven, and it's subject to shocks. But the tailwinds are starting to gather. From a market standpoint, sentiment has improved, credit spreads are tight, equity markets are pricing in better earnings, economic releases have been surprising on the upside, and yet the question remains, are we too sanguine on the credit perspective? Valuations in both high yield and high grade credit are rich by historical standards. There is value, but selectivity is essential, especially given the lingering risks from geopolitics and trade. Still, the bid for European assets continues, supported by global investors diversifying away from U.S. exposure. Investors should remain cautiously optimistic, especially in credit, but with a vigilant eye on trade risks, margin pressures, and regional divergences. If Germany's momentum holds, the European story could shift faster than many expect. As always, we'll be watching, and we'll be back next quarter to break it all down again. That's all for this edition of the Credit Compass. If you found today's episode helpful, please like, subscribe, and share it with friends and colleagues. If you have a question or a topic you'd like us to cover, get in touch. We'd love to hear from you. And for more in-depth financial research and credit ratings, please visit us at kbra.com. Till next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.